What if I told you that the stock market is crashing not because of bad news, but because of how investors interpret good news? In this video, we'll uncover the hidden forces driving the current stock market volatility. We'll address three critical questions. How does the jobs report impact market sentiment? What role does investor psychology play in market movements? Why might lowering interest rates not be enough to prevent a recession? But first, let's dive into why the recent jobs report has sent shockwaves through Wall Street. In today's economy, data is king. Companies like Google, Amazon, and Facebook have built empires by collecting and analyzing data. However, when it comes to economic data, sometimes less is more. And that's exactly what we're seeing with the recent jobs report. The August jobs report showed an addition of 140,000 jobs, falling short of the expected 160,000. At first glance, this might not seem like a big deal. After all, it's just 20,000 jobs, right? But here's where it gets interesting. Over the past year, we've missed job growth expectations by nearly 1 million jobs. This massive shortfall is shaking investor confidence and raising red flags about the true state of our economy. It's not just about the numbers, it's about the story they tell. And right now, that story is one of an economy that might not be as robust as we thought. Historically, job reports have been a key indicator of economic health, often influencing everything from consumer spending to Federal Reserve policy decisions. This recent trend of consistently missing job growth targets suggests a potential slowdown in economic expansion, which could have far-reaching implications for various sectors of the economy, from retail to housing. So, how can missing job expectations by just 20,000 in 1 month cause such a panic? It all comes down to investor psychology and the power of expectations. In the stock market, perception is often reality. When investors lose faith in economic projections, they start selling. This creates a feedback loop. Negative expectations lead to selling. Selling causes prices to drop. Dropping prices reinforce negative expectations. The cycle continues. This self-fulfilling prophecy can turn a small setback into a market-wide panic. It's like a game of financial hot potato, where no one wants to be left holding the bag when the music stops. Negative market sentiment can significantly hinder investment decisions and overall market stability. Learning to manage these effectively is crucial for both individual investors and the market as a whole. Here are some strategies. Develop the ability to move on from negative news. Don't let one bad report dictate your entire investment strategy. Express concerns healthily through techniques like discussing with a financial advisor or journaling your thoughts. Understand the spotlight effect in the market. Recognize that while a piece of news might seem catastrophic, its impact may be less severe in the long run. View market challenges as expected punches in a metaphorical fight to develop resilience as an investor. Now, you might be thinking, but the Fed is about to lower interest rates. Shouldn't that help? Here's where things get complicated. The Federal Reserve is indeed expected to lower interest rates in the coming weeks. Typically, this would be great news for the stock market. Lower interest rates mean cheaper borrowing, which can stimulate economic growth and boost stock prices. However, there are several catches. The Fed may only lower rates slightly, which might not be enough to stimulate the economy significantly. Inflation is still a concern, hovering around 2.9%. This limits how much the Fed can cut rates without risking a resurgence of inflation. The US can't easily print money to solve another recession without risking massive inflation, unlike in previous economic downturns. These factors combined create a perfect storm that could push us into a recession despite the Fed's efforts. It's like trying to stop a freight train with a bicycle brake. The tools at hand might not be powerful enough for the task. Learning how to navigate volatile markets is essential for long-term financial success. This includes understanding the basics of market cycles and how to read economic indicators. Consider these strategies. Diversification. Don't put all your eggs in one basket. Spread your investments across different sectors and asset classes. Dollar cost averaging. Invest consistently over time rather than trying to time the market. Focus on fundamentals. Look at company financials and long-term prospects rather than short-term price movements. Stay informed. Keep up with economic news and market trends, but avoid making impulsive decisions based on headlines. Remember that successful investing is often about patience and discipline, rather than finding get-rich-quick schemes. Many investors have lost fortunes due to a lack of financial education. To avoid this pitfall, invest time in learning about money management and investing. Here are some key areas to focus on. Develop discipline in spending and saving. Create and stick to a budget, even as your income grows. Learn to read financial statements and analyze companies. Understand different investment vehicles, from stocks and bonds to real estate and cryptocurrencies. Stay informed about market trends and economic factors, but avoid making impulsive decisions based on short-term fluctuations. Consider seeking advice from financial professionals, but always strive to understand the reasoning behind their recommendations. Remember, financial education is an ongoing process. The financial world is constantly evolving, so it's important to stay informed and adapt your strategies accordingly. The decision to invest in a volatile market is more than just about numbers. It's about your individual goals, risk tolerance, and peace of mind. Understanding the mechanics of market movements, economic indicators, and investment strategies allows you to make informed decisions that are appropriate for your own scenario. Remember, personal finance is exactly that, personal. What works for one individual may not be the ideal option for others. Consider your overall financial situation. Do you have high-interest debt that should be prioritized? Are you maximizing your retirement contributions? Do you have enough emergency funds? All of these aspects should be considered while making your investment decisions. Ultimately, the ideal method may be a balanced approach. You might invest the majority of your excess income while still keeping some cash on hand for emergencies or future opportunities. This way, you're setting yourself up for long-term success while simultaneously protecting yourself against short-term market volatility. Whatever you choose, the key is to be deliberate with your finances. Whether you're actively investing, building up your cash reserves, or both, you're taking great steps toward financial independence. And this is something to be proud of. Navigating the volatile stock market demands a blend of knowledge, emotional control, and strategic decision-making. Developing these skills while maintaining a long-term perspective is crucial for working towards financial goals in uncertain times. Remember, financial success is a marathon, not a sprint, requiring patience and persistence. Implementing sound investment strategies can lead to significant improvements in your financial situation over time. Adjusting your approach based on current market conditions is essential for maximizing potential returns. Sharing experiences and insights with others can provide valuable perspectives and foster a community of informed investors.